Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Matthew Ricciardella. He has over 20 years of experience in the real estate industry and has been a principal in over $1 billion of real estate transactions. His firm, Crystal View Capital, acquires and manages self-storage and mobile home communities across the U.S. and currently has $500 million in assets under management. So Matthew, thank you so much for coming on the show today.
Thanks for having me, Charles. I appreciate it. Excited to be here.
Yeah, so please tell us about yourself, both personally and professionally, prior to getting involved with starting your current firm, Crystal View Capital.
Yeah, so before I started Crystal View, rewind pre-2014 when we launched our first fund, from about 2007 to 2014, I was an investor just in my own right. I was buying self-storage and manufactured housing communities just for my own account. I was an owner-operator. I put together a small management company to manage those assets, and we did extremely well. The issue we had was our capital was limited, so we had no ability to really scale. And it was a great business model. It still is today, but without capital, you're just passing on so many deals. So that's why we went and launched our Fund One. Prior to that, I was a residential realtor in Southern California. I grew up in upstate New York, was in the restaurant business. My family was in the restaurant business, so I grew up as a kid learning the value of hard work, was in the kitchen washing dishes and waiting on tables and doing all that good stuff. So that was kind of what I did as a teenager and even before that. But did well, moved out to California, did well as a realtor and kind of built my business up making cold calls because I didn't know anybody. I was very new and young, and the only way I could do it was be super aggressive and get out in front of buyers and sellers. So I got on the phone, I knocked on doors, and that's how I built my business up. And it was really came back to, it was interesting, Charles, it was the power of relationships at the end of the day. Yes, we're buying buildings, we're buying land, but more importantly than that, we're building a relationship. And that's what allows Crystal View to be successful. That's what allowed me personally and professionally to be successful prior to forming Crystal View.
Awesome. Thank you so much for that. Can you break down what your kind of current company's investment strategy and criteria is and the different asset classes that you focus on?
Yeah, right now it's two asset classes exclusively: mobile home communities and self-storage facilities is our core focus.
And being involved with a number of different asset classes, especially from real residential to what you're doing now, how did you choose those two asset classes over? I mean, there's a dozen different real estate asset classes that you can really choose, let's say.
Yeah, and I invested in all asset classes. I invested in multifamily, in office, in retail, industrial, and I gravitated back to these two property types. And the reason for that was several reasons. One, I found that the ownership profile was really ideal for what I was trying to accomplish. We're a hands-on owner-operator. We look to create value. We're a value-add player in the space. And if you're buying fully stabilized assets from an institutional owner that are that are priced per the market, it's really difficult to make money in that type of scenario. However, if you're buying assets off market and there's a lot of operational inefficiencies there, and you've got the wherewithal and the competency and the systems in place to identify where they're underperforming, and you have the ability to pull out that value, create that value, and you're finding these deals off market, you can make a lot of money in this business. So for that reason, I found that self-storage and manufactured housing were really predominantly mom and pop owned and operated. It's very fragmented. Like if you get into office and industrial and retail, multifamily, got a lot of large players that dominate and own a big chunk of the overall asset class. That's not the case here. A lot of fragmentation, and that was why I really put my focus on these two asset classes and still do to this day.
Yeah, I think when I was preparing for this episode, there's one kind of recurring theme that I found over the years. People that are doing funds with mobile homes and self-storage, off-market is a huge part of their deal sourcing versus, like you just said, we have a lot of multifamily people on the show. And that's one thing where a lot of that is all brokers. It's like inverse. You know what I mean? It's completely inverse. And so when I was looking through for stuff for this episode, I saw that you acquire over 92% of your deals off market. I mean, is that where your firm is actively reaching out to owners, or are you what people would say off market, via brokers?
Well, it'd be the combination of both. We have a reputation in the space for doing what we say we're going to do, so that's a great place to start. There's a lot of operators in this space that are less than scrupulous. There's a lot of operators that don't have the financial wherewithal to take assets down. And merely what they're doing is they're tying deals up, wasting time, trying to assign contracts, acting kind of like a quasi broker, if you will. So we've got a reputation in the brokerage community that our word is our bond. We execute. We've got capital. So a lot of brokers do bring us deal flow that's off market because they know in a lot of cases we're the best suitor. But more often than that, even we're reaching out. We have a team, Charles, of 9 full-time professionals, and they're reaching out directly to these owner operators, and they're building relationships. They're going out there to visit them. They're having dinner with them, lunch with them, listening to their life story, understanding how hard they work to build this up. And we're relatable because we're their peer. It's not like we're approaching them, hey, I'm a salesperson here, but no, we're a fellow owner operator. And we're kind of, best practices are going back and forth. We're sharing ideas. It's a mastermind. And that process doesn't happen overnight. A lot of these relationships I've built for more than 10 years. So these people know that we're active. We have those relationships. And when it's time to sell, more times than not, they're going to reach out to me or somebody on my team. And that's how we're able to put these deals together. And these are fair prices. I mean, it's not like we're stealing these deals, but we're not competing at the same time. So it's really a win-win. We're interested in structuring win-win transactions, and that's the.
Yeah, when I've done cold outreach for multifamily properties, it takes a long time to build that rapport with the seller, and maybe they're not even ready. They're not even a seller yet. They're just an owner, but you are top of list when they do come to that realization that they're going to be selling this property.
Absolutely, and especially when they know that you've got the ability to close, and you could work under their terms. Some sellers are tax motivated. We have specific tax strategies to meet those goals. Some want a quick close and they want all cash. We could do that. Each deal is a little bit differently. The trick is you need to structure it around what their motivation and what their goals are.
Right. That brings me to my next question about the financing portion of it. What types of financing do you typically use to capitalize your properties? And you're saying that obviously every deal is a little different. I imagine some of these are seller financing, but do you also utilize a lot of for these asset classes? This is much more like local and community banks type of funding that you normally reach out and acquire?
It's a combination. A lot of times it's all cash. What we do is we take deals down typically for cash. Then what we do is we have a revolving line of credit. In our Fund 4, we have a $50 million line of credit. In our Fund 3, we have a $75 million line of credit. So once we take a deal down, typically it's underperforming or non-performing in some way, shape, or form. So we don't want to put permanent debt on the deal. Otherwise, we're going to really have a super low loan to value on that deal. So what we want to do is maximize NOI first, then go out to, on the mobile home park side, Fannie and Freddie, which is our go-to debt financing source. And then on the storage side, it's the CMBS market. But during that interim period from the time we acquire it for cash and the time that we lock in that long-term fixed rate debt with either one of those debt sources, it typically sits on our revolving line of credit.
Yeah, and I imagine that's something that a lot of your competitors, it's the first time I've heard that on doing so many of these episodes. So with an operator in those asset classes, I imagine that gives you a leg up on your competitors because they might not be able to bring cash to a deal, in that form.
Well, that's exactly right. Cash is king, and your ability to, when we approach a seller and show them a proof of funds, it's very different than when the seller is having a conversation with the syndicator that says, hey, let me tie your deal up. Yeah. I'm going to go out there and try to raise it. And trust me, I could do it. I mean, it's logical that they would go to us. It's just certainty of execution.
Yeah. And I imagine for a broker that takes, they're coming in, they're paid only on commission. and they're bringing a deal to you, and they know that, well, the financing contingency is not really there anymore. So that's one nice thing. And it's really just we're coming to terms and pricing.
That's it. That's it. So if everything checks out, we're going to close on that deal.
Fantastic. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. One of the things I saw, and I know this is much more normal in self-storage and mobile home communities, is like bringing your property management in-house. And since you're buying across the United States, property management's a challenging business, but what are the main reasons behind being vertically integrated and bringing that all in-house under one roof?
Yeah, great question. I think this is one of the differentiating factors in Crystalview and what makes us different from a lot of our peers and competitors. And the answer to that question, Charles, is we want to control our own destiny. And I'll tell you what that means. First off, what a lot of groups do is they're what I call a capital allocator. They go out to the general public, they raise capital, and what third doing is they're saying, hey, I found a great deal. I'm going to allocate capital into this deal, and then I'm going to call a third-party property management company. They're going to engage with them, and they're going to say, hey, I hope you do a great job for me and my investors. Go out there, collect the rents. If you could find some homes, fill vacant sites, I trust that you're going to do a great job. That property manager, not taking anything away from them, they're only in it to earn their fees. So whether that property does extremely well or it's a failure, it doesn't really matter that much to them. For us, there's this really strong alignment of interest between ourselves and our investors. I put a significant portion of my net worth into these funds as a limited partner right alongside my investors. I've got a strong vested interest here. So I don't believe anybody can do as good of a job in managing that property and executing the business plan to maximize net operating income. Nobody could do it as well as our team can. So that's why I say we control our own destiny. We create all of that value in-house. And if we did it any other way, I don't believe Crystalview would be able to deliver the returns as we have in the past.
Yeah, I was reading on in one of the bios or one of the things that you're invested 8 figures into all your funds over the years.
That's right. Now, that's a good chunk of capital, obviously. I wouldn't feel comfortable pulling out the yellow pages and calling a third-party property management company and trusting that my 8 figures are going to be maximized with them. I know nobody's going to maximize the return on those 8 figures better than myself. And my investors believe that too, and that's why they invested in me.
So, Matthew, over all the decades of doing this, different asset classes, how has your investment strategy evolved over the years? Because I remember, when I started multifamily investing in 2006, it's changed dramatically. Every couple of years, I'm fine-tuning what we're buying, what vintages, everything like that. How has yours over the years changed?
Put simply, Charles, the strategy hasn't changed very much. What has changed, back to that vertical integration, back to the power with controlling our own destiny, we've really refined our systems, our operations. In the past, it was more or less, hey, you find a great deal, you buy it right, you bring the rents to a market level, and you're done. You pull that one lever, right? That ship has kind of sailed in this business. Yes, those exist, but they're few and far between. If you want a scalable business, you need to be more than a one-trick pony that could just pull one lever. You need to be able to bring homes in and fill vacant sites. You need to be able to add more storage units. You need to have the ability to cut costs where you need to, sub-metering utilities as an example. We've got all those capabilities, all that functionality under one roof. So that's really how our investment process has changed, is we've got more mechanisms, more levers to pull to create value than we did in the past. But the strategy itself is finding an undervalued asset, put simply, creating value, cash flow, and then you sell the investment at some point down the road for very attractive returns. The strategy is the same. It's just we have more means to create better returns for our investors.
Yeah, that makes perfect sense because I'll get these emails from, general partners trying to pitch their deals and, syndicators. And, you'll see the same business plan in a lot of them in all different asset classes, you know what I mean, throughout commercial real estate. And so it's very interesting that you've added on additional, like you said, levers to pull for specific deals in order to really, push that value and really the NOI and everything for the properties.
Absolutely.
So one significant benefit when I see mobile home communities is really the lack of new supply. I mean, it's not really something that people want in their backyard. You really have like a moat around that business. One thing though that's different with self-storage though, I was reading that in 2023, construction for self-storage was like $6.9 billion or something, an all-time high, which is like 500 or 600 new complexes. So how has like this new supply for self-storage affected the industry and your different funds and investments?
I'm going to say it's market specific, Charles. You're absolutely right with your comment on the manufactured housing side. We call it NIMBY, not my backyard. They're really not allowing any new mobile home communities to be built. So you've got this tremendous advantage from being a park owner. You've got very limited or shrinking supply and exploding demand. So it's fantastic dynamic. On the storage side, you're also right you're looking at it broadly, right? So you've got all these new facilities being built. With that being said, we're really focusing on secondary and tertiary markets. A lot of those facilities aren't being built by mom and pops. They're being built by REITs, institutional capital, and private equity-backed developers. That capital wants to see new facilities built in your prime markets. Your New York City, your Los Angeles, your Dallas, you're down in South Florida. I'm sure you'd see these things popping up left and right down in Miami. So that's kind of where that capital wants to be. And we're in some of these smaller, obscure markets. I could give you the names of the cities, like Missoula, Montana, as an example. We're in some small towns in Michigan, in Wisconsin, in Indiana, outside of Indianapolis, where you're just not seeing a lot of that new supply coming in. So those dynamics of limited supply and growing demand that you're getting on the manufactured housing side, you're still getting that on the storage if you're invested in the right markets. And for us, those are secondary and tertiary markets.
Yeah, that makes perfect sense with the institutional money pushing it. Yeah, they're not going to be going into those markets. I never really thought of it like that. They're going to be pushing for your more prime markets. I imagine it's easier for them to justify putting up new complexes.
That's absolutely correct.
So over the years, how has your relationship towards money changed from starting as a broker, coming from New York to Southern California to where you are now with, I think you're 3 funds in or 4 funds in?
Well, it's I guess from an investor standpoint is how you're asking, how it's changed?
Yeah, just it could be personally or it could be professionally.
Okay. Look, at this stage, I love what I do. And if I didn't, I'd probably go off and do something else, whether that's sitting on the beach or playing golf or doing something. But I find more joy and thrill in being with you here today as an example, or finding a great opportunity and creating value or inspiring a team. I find that I could be a lot more productive member of society doing those things versus some of the other things I mentioned before. But the way that relationship with money has changed is I'm really looking to compound that wealth, to do this at a larger scale and have a larger impact in society, to give back more. So the way I'm thinking about investments today is how do I compound this? Let me find a great investment vehicle, i.e. Crystal View. Let me go out there and execute, build a great team around myself, and then how do I continually reinvest, and kind of get this thing on automatic pilot so my gains and my wealth is compounding over time. And that's my investors get to coattail ride on that philosophy and that way of thinking, because that's the same exact vehicle that we're providing to them. So I think, rewind back to 2004 when I got started, I didn't even understand what the definition of compounding returns was. I was just trying to make enough money to eat, to buy a pair of sneakers, and just basic living expenses at that point. So then you become independently wealthy, and you really have to find where your passion lies. And for me, it lies in doing what I'm doing. I'm very lucky in that. But really, the name of the game is compounding returns and compounding wealth and leaving a legacy behind.
Yeah, how you explain your deals is different from how most syndicators, and I like it where they're riding alongside you or they're joining you in the investment. It's not really like you're offering them something. It's really, hey, I'm doing this. Do you want to join in with me? And I think that mindset is much more comforting for a passive investor where, hey, someone's done it so many times. I'm joining them. They're allowing me into this opportunity. It's a whole different kind of, I wouldn't say sales process, but like a whole different kind of presentation of how you're bringing them deals.
Yeah, it's a different relationship. Typically a sponsor such as myself, which is somebody who's out there raising capital from the public, whether it's retail investors or institutional capital, a lot of them are thinking about it as I'm a fee generator. So their thought process is, how do I bring in capital to generate fees? And perhaps the decisions they make aren't in direct alignment of interest with their investors. The way that I'm looking at it is we're partners, and this is a partnership, and I've got a big chunk of my own capital invested alongside you. Yes, I still earn fees as well. You've got to compensate talent, you've got to pay the light bill, you need office space, you need to have fees in place. But the most important thing is the alignment of interest. We eat our own cooking, as we like to say, and that creates that bond, that creates that partnership. Writing a check separates conviction from conversation. So if anybody is thinking of investing in a sponsor, I think the first logical question to ask is, how much of your own money do you have invested?
Yeah. No, it's a very important question. And there's a lot of people out there that don't put money or that much money into their deals, and it doesn't show that really solid alignment of interest.
Agreed.
What are common mistakes that you'd see real estate investors make over the years, whether it's in your asset classes that you focus on or maybe real estate in general?
I see, first off, truth be told, I've made my share of mistakes. Let's just be clear on that. I see a lot of my peers and competitors making mistakes, and we're constantly learning from our mistakes. I think the biggest mistake, I can't really speak for them. I know recently, which is topical, the biggest mistake, and this is generally speaking, investors made, was overly optimistic underwriting assumptions and taking deals down with floating rate debt. So when you couple those two together, where you didn't hit your pro forma and your projections, and your debt ballooned from 3% to where you underwrote it to 6 or 7% today, you've got a major problem. So I think that was the largest problem that was made by real estate investors over the past 24 to 36 months. Fortunately, we didn't make those mistakes. All of our debt is fixed. We were very conservative. We've got a diligence team, and we're very conservative in our underwriting. The largest mistake I made was with people, Charles. Selecting the wrong people on the management team for a certain job. And then once I've identified that they're not the right person, maybe it's because, your heart's too big, or you just didn't fire that person. And that made a bad problem worse. It just proliferated it. So I think any advice I could give to somebody who wants to scale a business and really create a dynamic team, find the best talent you can, put them in the spots where they're going to shine. And if it's not working out, be quick to cut the cord. And because it's a disservice to them, it's a disservice to you, to the company, and to your investors to leave that person in a position where they don't belong.
Oh, that's a lot of great information there. So Matthew, thank you so much for coming on today. How can our listeners learn more about you and your business?
Yeah, no, it's great being here. I enjoyed it. If anybody wants to learn more about what we're doing, you could reach out to us at invest@crystalviewcapital.com, or you could visit our website at www.crystalviewcapital.com.
Thank you so much for coming on today, Matthew, and looking forward to connecting with you here in the near future.
Likewise. Thanks so much, Charles.
Bye-bye. Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.